Welcome to my channel. I'm Scott, and in this video, I am going to walk you through the process of valuing Alset EHome stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Alset EHome specializes in land development, home building, sales, rental, and property management. It provides quality designer homes with integrated smart technologies at affordable prices. 77% of people want to learn how to live more sustainably, which implies people are willing to pay more for eco-friendly products. This company is building eco-friendly communities, not just eco-friendly homes or products. It has three business models. The first is an Alset style home with a free solar energy system and a free Tesla. The second is renting an Alset home that comes with a free solar energy system and a free Tesla. You heard me right, it comes with a free Tesla. The name of the company is Tesla backwards. They're really trying to leverage off the Tesla brand. Elon Musk is not part of the company, but I could see him being part of them in the future. Their third business model is creating a REIT that pays a 6% interest rate. REIT stands for Real Estate Investment Trust. A REIT is a company that owns and collects rent from commercial or residential properties. It's just a corporation like Coca-Cola or Microsoft. Coke's business model is to sell soda. A REIT's business model is to collect lease or rent payments from the real estate they own and then pass that on to investors in the form of dividends. A REIT must pass on at least 90% of its profits in the form of dividends. Alset homes are designed to look modern and eye-catching. Since every home comes with a Tesla and Tesla solar roof and panels, energy is stored in Tesla facilities, so it is readily available during high demand periods. To earn extra money, you can have your car become a robo-taxi. When you're not using your car, you can simply press a button on your phone and your Tesla will act as a taxi service. When you need your car back, you can simply press another button so it comes back to your house right away. Or if it's carrying a passenger, it will come home when it completes that ride. The reason you get a Tesla with your home and not a different EV is because of Tesla's future plans to build a robo-taxi service with its fleet of cars. One of its projects is a 197-acre lot that can fit 689 residential homes. That's located in Frederick County, Maryland. All the homes have been pre-sold. This is an affluent community that is central to many big cities. They are working with NVR, the fourth biggest home builder in the U.S. The only home builders bigger are D.R. Horton, Lennar, and Pulte Group. As of today, NVR's market cap is $18 billion, and each share of stock is a little over $5,000. Another project is near Houston, Texas, in a high-end city called The Woodlands. It is 136 acres of land with plans to build 748 homes. Mr. Chan Hang Fai is a chairman of the company and has experience with REITs and many other companies. He is a very successful businessman and entrepreneur. Definitely a good person to invest your money in. His average IRR is a whopping 50%. IRR stands for Internal Rate of Return. The company is headquartered in Bethesda, Maryland, and was founded in 2014. It started trading in 2020 and can be found on the NASDAQ and Deutsche Börse. Let's get started with the model. This is a micro-cap company, 96 million market cap. They're trading at $2.40 a share, and they have 40 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they did have positive free cash flow in 18, 19, and 20, but negative 9 million in the trailing 12 months. Net income is the profit or loss on the income statement, and that's negative every year. Revenue is the sales for the company, and that's pretty flat, from 20 million up to 23 million. This is the company's income statement. The top line is the revenue, the sales. Here's a breakdown of their revenue in 2019 and 2020. In 2019, they had 23 million of revenue from property development. This is the sale of properties in their Maryland and Texas locations. That dropped to 13.6 million. It's going to take a few years for them to develop their properties. Their biohealth division grew from 1.4 million to 2.6 million. So the company has doctors and scientists doing research and development, and they've been producing natural foods and supplements. And those are sold to distributors, and those distributors sell their products to retail stores all around the world. This segment is much more scalable than their property development. Below revenue is cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that's positive each year. But their SG&A expenses are higher than their gross profit, so they have negative operating income every year. They pay $323,000 of interest on their debt in the trailing 12 months, and they do have a big negative net income in the trailing 12 months. And that negative $76 million is mainly due to the second quarter of 2021. They had a lot of items in other income and expenses. They had a $50 million financing cost and a $21 million unrealized loss on some securities. And these items don't affect cash flow, so you'll see in a statement of cash flows, they didn't lose nearly close to $76 million of cash. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses or generates from its operational business. So they were generating positive operating cash flow. They lost $9.2 million in the trailing 12 months. But as they're building out their properties, their operating cash flow will probably be negative. And then when sales start rolling in for the properties or rental payments start rolling in, then operating cash flow will turn from negative to positive. They don't spend too much money in CapEx. The most they've spent was $100,000 in the trailing 12 months. So they're mainly running their business on capital stock. They issued $1.9 million in 2019, $13 million in 2020, and $52 million in the trailing 12 months. Every time a company issues capital stock, that increases the shares outstanding, making your shares less valuable. So they do have negative free cash flow in the trailing 12 months, but they did have positive before that. This is the company's equity section of their balance sheet. They have $87 million of equity. They raised $205 million from issuing stock, and they lost $118 million from running their business. Retained earnings is a sum of all your prior net incomes. Let's look at their capital structure. $87 million of equity, $7 million of debt. They're 93% equity, 7% debt. And you can see their net debt is negative because they have a lot of cash on their balance sheet. So they could pay off all the debt on their balance sheet if they wanted to. Their weighted average cost of capital, which is a blend of the cost of equity and cost of debt, is 9.58%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's $203 million. We discounted those numbers back to today's new weighted average cost of capital. We get a value of the company of $96 million. We divide that by 40 million shares, and we get a calculated stock price of $240. So I didn't value this company. I just showed you what their future free cash flows would need to be to justify a $2.40 stock price. So I imagine their free cash flows should be negative because their expenses will be high as they're building their infrastructure on their homes and their properties. And then all they need is $14 million of free cash flow in 2024 for the stock to be worth $240, which I think is pretty low. And the reason it's so low is because their market cap is only $96 million. This seems like a really innovative company. If they built their market cap to $10 billion, that's 100x your money. I know that's not easy to go from $100 million to $10 billion, but every company started somewhere. Even Microsoft started as a few $1,000 company, and now they're a $1 trillion company. They do have some really lofty plans, but they do have a chairman who has executed on his previous business plans and made them successful. If he can make this successful, he can make you a ton of money. I could only find 2 analysts that priced this stock, and their average price target was $202. So it looks like the stock IPO'd around $6 a share, and then it was really pumped up, close to $28. And then there was a huge sell-off, and now the stock is below its IPO price. So this is just a crazy stock price movement for such a short time frame. If Elon Musk just tweets about this company, their stock price will probably go up 5 or 10x. In the past 52 weeks, their stock is down 66%. While the S&P 500 is up 33%, the 52-week low was $1.65, the high was $29, and the stock is trading below its 50-day and 200-day moving average. 5 to 8 million shares are traded each day on this stock. Of the 40 million shares outstanding, 21 million are on float, 3% are held by institutions, and about 3% of the shares are shorted. Here's a list of the company's short interest. The peak was on 7/15 when 2 million shares were shorted. It seems like the short percentage was growing a lot, and then it's tapered off. Since the stock is coming down so much, there's not much room to short it. But if it gets back up there to $5, $10 a share, the short interest will definitely climb. If you invested $10,000 into this company when it IPO'd, you'd be at $3,400 today. That's a big loss. The chairman and founder of the company owns 45% of its stock. Let's look at their financial ratios. We can't look at the PE since they have negative net income. They do have a decent price to sales ratio because their market cap has come down so much. And they also have a really good price to book since they've been raising capital. They have a price to book of 1.1, much better than the market median and average. They recently raised some capital, so they have 90 million of cash on their balance sheet. So they have a really high current ratio and quick ratio. They do seem adequately funded. They had negative 9 million of free cash flow in the trailing 12 months, but they have 91 million of working capital. So they should have enough funding for the next 12 months. So to summarize, I think this company has some really lofty plans, and it could be a multi-billion-dollar company. But plans and ideas are meaningless. It's execution that's important. We've all had ideas for a flying car, but none of us can make it. If we could make it, we'd be rich. The positive thing is the chairman and founder of this company has executed on a lot of his business plans and is really successful. And I think it's a smart move to attach Tesla to his eco-friendly environment, because if Elon Musk gets involved, this company will blow up. I rank their free cash flows 1 out of 10, their revenue 1 out of 10, and their ratio is 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.